Hi, and welcome to Lesson 4 of the Blueprint course. Today, we are diving into direction, also known as trend. In this lesson, you will learn what a trend is, the rules for determining type of trend we are operating in, and even how to anticipate trend changes in advance. Sound exciting? I promise it's a game changer. Let's jump right in. As I mentioned in the previous lesson, the 3-step process is a framework that will guide you throughout your trading career. By now, it should feel familiar and intuitive. In the last 2 lessons, we focused on location and reinforced it through practical application sessions. Now, it's time to move on to the 2nd step of our multi-timeframe analysis, direction. Direction is all about identifying the trend on the chart. Just like location, we rely on the higher time frame, HTF, to perform direction analysis. This step is incredibly important. It's one of the key pillars in determining whether a zone on the lower time frame, LTF, is positioned in the optimal context for a trade. Without alignment in direction, even high-quality zones can fail to deliver favorable outcomes. We will spend some time on this slide because it introduces several critical concepts about trend direction and how to effectively navigate it as a trader. To start, any market can move in one of 3 directions. Upward movement, called an uptrend. Downward movement, referred to as a downtrend. Lateral movement, often described as a sideways trend. While it's straightforward to recognize an uptrend when prices rise or a sideways trend when prices stabilize, the more significant challenge lies in determining where we are within the trend's life cycle, whether we are in the early, middle, or late stage of a trend. This is important because identifying a trend early on provides the largest profit potential. This is where anticipatory trend analysis comes in. This advanced method aims to predict trend changes before they occur. While this approach is the most complex and challenging, it also offers the highest profit opportunities by allowing us to catch trends at the beginning. Once a trend is defined, the next question is equally crucial. Where do we enter? Are we positioning ourselves at the start of a new trend where there's room to capitalize on price movement? Or are we approaching the end of an existing trend where price is more likely to reverse? Understanding this distinction is essential for maximizing profit while managing risk. Let's now connect this idea with higher time frame HTF direction, often referred to as fractals. When observing the structure, you will notice a classic bell curve shape, within which key formations like rally-base rally and drop-base rally emerge. These formations mark pivot points on the higher time frame, areas where price transitions from a corrective move to an impulsive move. These pivots frequently align with zones of high quality supply or demand, helping us objectively determine trend direction. In a sense, a trend is simply price moving between higher timeframe supply and demand zones. We also distinguish between 2 types of price action. Impulse moves. These are strong directional moves, such as sharp green candles in an uptrend or strong red candles in a downtrend. Corrective moves. These are weaker counter movements, like small red candles in an uptrend or small green candles in a downtrend. Our goal is to participate in impulse moves, as they carry the momentum and offer the best profit potential. To achieve this, identifying the difference between impulse and correction is critical. In summary, as traders, our primary objective is to maximize profit potential by positioning ourselves correctly within the larger price context. This means optimizing our risk to reward ratio and aligning our trades with the dominant trend direction while entering at the most favorable stage of the trend. This slide perfectly sums up everything we have just discussed about trend analysis. Trend analysis helps us in two key ways. First, it allows us to identify the direction the market is moving. Second, and perhaps more importantly, it helps us determine when the market is likely to change the direction, or as we like to say, where is the end of the bend. It's important to remember that a trend is simply price traveling between higher timeframe supply and demand zones. By anticipating a trend early, we gain significant advantages: higher profit margins, better risk to reward ratios, and the ability to stay in trades longer, effectively riding the wave for extended periods. To perform trend analysis effectively, we rely on pivot highs and pivot lows. These are significant turning points on the chart that signal changes in direction, giving us the insights we need to align our trades with the market's momentum. Let's dive into a scientific approach to defining trends and systematically analyzing them on a higher time frame, applicable to any price chart or market. As we discussed earlier, we use pivot points to identify directional trends. Pivots represent the true turning points in price action, helping us pinpoint changes in direction with precision. Looking at this chart, we start by focusing on the current price and work our way from right to left, identifying the 6 most recent pivot points. Typically, we look for 3 pivot lows and 3 pivot highs. This process provides us with a structured foundation to analyze the market's current trend. Once these pivot highs and lows are identified, we sequence them from left to right. In this example, the sequence shows a low followed by a high, then a higher low, a higher high, another higher low, and finally another higher high. This pattern confirms the presence of an uptrend, as an uptrend requires at least 2 consecutive higher lows. In an uptrend, it's important to note that lows carry more significance than highs. For instance, even if the highs are at the same level, the market is still considered to be in an uptrend as long as we observe 2 higher lows. This concept is illustrated clearly in the small figure on the left side of the slide, where the higher lows define the trend's upward structure. For a downtrend, the process is essentially the reverse of what we do for an uptrend. We start by identifying the 6 most recent pivot points on the higher time frame, working from right to left on the chart. Once these pivots are identified, we sequence them from left to right to analyze the market's direction. In this example, we observe the following sequence: a high followed by a low, then a lower high, a lower low, another lower high, and finally another lower low. This pattern confirms a downtrend because it includes at least 2 consecutive lower highs. These lower highs indicate that sellers are maintaining control, consistently pushing the market to lower levels. In a downtrend, the highs are more significant than the lows. Even if the lows remain at the same level, the presence of 2 lower highs still defines the market as being in a downtrend. This concept is illustrated in the figure on the left, where the lower highs form the key structure of the downward trend. If we don't have an uptrend or a downtrend, the rule is straightforward. If there are no consecutive lower highs or consecutive higher lows, the market is in a confirmed sideways trend. As a rule of thumb, when no clear trend is recognizable, we simply define the market as sideways. This happens when price lacks a clear directional bias and moves within a range. Before jumping into practical applications, let's take a moment to clarify the difference between impulse moves and correction moves and how they shape our trading approach. Impulse moves are the dominant directional movements in a trend. They are characterized by high speed, abnormally large candles that often slice through zones on smaller timeframes with ease. These moves are fast, powerful, and cover a significant price range. Impulse moves represent the core of what we aim to capture in trading because of their speed, strength, and profitability. Correction moves, on the other hand, are pullbacks from the primary direction of the trend. They tend to be slower with smaller candles and cover less price distance compared to the impulse moves. While our focus is on trading impulse moves, corrections provide excellent entry points for anticipate trend continuations. However, shorting a correction or trading against the trend is considered a counter-trend trade and comes with lower probabilities. When it comes to trade categories, we break them into 3 types. Trend trades are designed to capture momentum moves in the direction of the trend. These trades are statistically more probable and often more profitable, as trends are more likely to continue than reverse. This aligns with the classic saying, the trend is your friend until the end of the band. Counter-trend trades, by contrast, move against the higher time frame trend. They are less probable and less profitable, as they fight the dominant market force. Sideways trades fall somewhere in between. While they have slightly higher probabilities than counter-trend trades, they share similar characteristics and often lack the momentum of trend trades. Understanding the dynamics of impulse versus correction moves and the trade categories will set the foundation for aligning your trades with the strongest market forces. How does this look in reality? While we often observe correction and impulse moves, price doesn't always behave as neatly or predictably as we'd like. Instead of a clean correction, sometimes we see a larger correction that momentarily deviates from the trend. For example, price may pull back just enough to fill a nearby supply zone, only to drop sharply afterward, resuming the stronger impulse move in line with the overall trend. This phenomenon is what we call a fake move, a temporary deviation that can appear to reverse the trend, but ultimately reinforces the dominant direction. Recognizing these fake moves is crucial as they provide valuable opportunities to trade with the trend after the market traps counter-trend traders or fills institutional orders in supply or demand zones. Now let's dive into an exciting topic, advanced direction, and how we can use anticipatory trend analysis to elevate our trading decision. Anticipatory trend analysis focuses on predicting a change in price direction before it happens. You've probably heard the saying, the trend is your friend until the end of the band. Well, the goal here is to identify the end of the band and position ourselves accordingly. Why is this important? Catching the tops and bottoms of trends offers some of the best risk to reward ratios in trading. By entering at the turning points, we minimize risk by maximizing potential profit. That said, it's important to acknowledge that anticipatory trend analysis is one of the most challenging techniques to master. It requires the skill and discipline to identify a trend change before it fully develops, which often means acting on subtle market clues that can easily be missed. In the next section, we will break down this process step by step and explore how to apply anticipatory trend analysis in real market scenarios to refine your trading strategy. Let's get started. There are 2 primary ways to anticipate the end of the band: HTF trend theory and pivot theory. Let's start with the HTF trend theory. First, take a look at the daily Euro-US dollar chart on the right. At first glance, it seems straightforward. There's a clear daily uptrend with consecutive higher lows, HLS, and higher highs, HH. The trend looks strong and easy to follow, right? Naturally, it might seem like a no-brainer to buy here and continue riding the momentum. But let's take a closer look. If you observe the chart carefully, you will notice that price has been moving sideways for a while. This is an important clue and a classic sign that the trend could be losing steam. When price begins to consolidate after a sustained trend, it's often an early warning of a potential end of the band, signaling that the current trend might be about to reverse or weaken. This is why context is key, even in what appears to be a strong uptrend. Subtle signs like extended sideways movement can provide valuable insights into potential trend exhaustions. Understanding and identifying these patterns allows us to anticipate changes before they fully materialize. To effectively anticipate the end of the band, we need to zoom out and analyze the higher time frame, HTF. In this case, the monthly chart. The larger time frame provides a context needed to identify potential trend changes on the daily chart. On the monthly chart, we can pinpoint two critical observations. The monthly downtrend. Price clearly exhibits lower highs, LHs, and lower lows, LLs, signaling a consistent downtrend on the larger time frame. The monthly supply zone. Price is currently sitting in a high-quality supply zone, specifically a drop-based drop formation, which indicates an area where selling pressure is likely to emerge. Given the context, it becomes evident that the daily uptrend is actually part of a monthly correction move, rather than a sustained bullish trend. This suggests that the daily uptrend is temporary and likely to reverse. We anticipate the monthly downtrend will resume, initiating a strong momentum move to the downside. By aligning the daily trend with the broader monthly context, we can make more informed trading decisions and position ourselves ahead of the anticipated directional shift. This approach is a key element of the HTF trend theory, allowing us to identify high probability setups with a solid risk to reward ratio. That's why on the daily chart, we now see a clear shift into a daily downtrend, as shown here. The uptrend has given way, and the new trend aligns with the broader context of the monthly downtrend. Let me take a moment to loop back to a key point from the direction module. A trend is simply price moving between high quality HTF supply and demand zones. That's exactly what we are witnessing in this example. The daily chart's transition into a downtrend reflects the price moving away from a high-quality monthly supply zone, reinforcing the dominance of the larger trend. Now, tying this back to your income objectives, especially when working with hybrids like weekly and monthly income. It becomes clear why trading within the correct HTF context is so important. When the monthly context points toward a downtrend, aligning our lower time frame trades with this overarching trend increases both the probability of success and profitability. At this stage, the concept should start to feel much clearer, at least on a conceptual level. From here, we'll continue building on this foundation with practical applications to solidify your understanding. Let's now talk about the second method for anticipatory trend analysis, the pivot theory. This approach focuses on identifying potential trend changes by analyzing key pivot points. For a confirmed uptrend, we require at least 2 consecutive higher lows, HLs. Similarly, for a confirmed downtrend, we need 2 consecutive lower highs, LHs. But what if we already have 4 out of 5 pivots formed? In this case, we can assume with higher probability that a new trend is about to develop, even before the final pivot appears. For an anticipatory uptrend, we might observe 4 pivots already in place: a low, a high, a higher low, HL, and a higher high, HH. The only missing pivot is another higher low to fully confirm the uptrend. Here's where anticipation comes in. We expect this higher low to form in a high-quality LTF demand zone, ideally located in the low or very low context on the higher time frame. For an anticipatory downtrend, we see a similar setup but in reverse. The 4 pivots might include a high, a lower high, LH, and a lower low, LL. The missing piece is another lower high to confirm the downtrend. We anticipate this lower high to form in a high-quality LTF supply zone, located in the high or very high context. This method is a powerful way to predict trend changes because it provides a higher probability compared to the HTF trend theory. By focusing on pivots and context, you gain more clarity on how the trend is likely to unfold. However, while pivot theory offers higher probability, it may result in slightly less profit potential, as you are entering after more of the trend has already formed. By shifting your outlook from a sideways trend to an anticipatory trend, you gain greater confidence in your analysis and improve your profit margins by positioning yourself ahead of the market's next move. Let's take a look at this example. The product or market doesn't matter. What's important is the structure we are observing. On this chart, we can see 4 confirmed pivots, signaling the potential start of an uptrend. A low followed by a high, then a higher low, and finally a higher high. At this stage, we are one step away from confirming the uptrend. The key now is to predict the final building block, another higher low. This higher low should ideally form within an HTF demand zone, providing the support needed for the trend to continue. Now, let's see how this plays out. As price pulls back into the demand zone, it forms the anticipated higher low. This pivot completes a structure, confirming the emergence of a new uptrend and signaling a strong opportunity to align with the trend early. Let's summarize the key takeaways from this lesson. There are 3 main ways to trade within the context of direction. The first is trend continuation, which is the easiest and most reliable approach. By trading in the direction of the established trend, you align with higher probabilities and greater profit potential, as trends are statistically more likely to sustain than reverse. The second is confirmation using pivot theory. This method is more challenging, but can be highly rewarding. It captures the beginning of a new trend by anticipating and confirming pivotal changes in price direction. Finally, there's end of the band using HTF trend theory. This is the most difficult of the 3, but offers the highest profit potential, as it focuses on identifying the very start of a new trend. Catching a reversal at its inception can lead to exceptional risk to reward ratio. Why does this analysis matter? By mastering these methods, you gain the ability to identify trends early, allowing you to ride institutional waves and capture momentum moves. Additionally, you'll be able to recognize where trends may end, helping you avoid unnecessary risks and false setups. This understanding is especially important when trading within the HTF context, as it aligns with your weekly and monthly income objectives. Misalignment between the lower and higher time frame signals caution, reminding you to avoid trades that conflict with the broader monthly trend. With this knowledge, you are now better equipped to approach the markets with confidence, applying these strategies strategically and effectively. Let's revisit the trend rules on a rule card before we jump into another practical application. Here's an excellent overview of the trade management rules, including how they connect to anticipatory trend analysis. These rules build on concepts from the direction chapter, with targets and break-even parameters carefully designed to maximize the probability of success and profit margin. Let's begin with trade management rules for trend trades. These guidelines help you manage lower time frame LTF zones within the ideal context of a higher time frame HTF trend. Break-even rule. Once your trade achieves a 1:2 risk to reward ratio, move your stop loss to break even. This ensures that if the price reverses back into the zone, your capital remains protected, effectively turning the trade into a zero-sum game. Targets. Set your first target at a 1:4 risk to reward ratio to lock in profits early. For the second target, let it trail based on HTF zones. Adjust your stop loss just below for longs or above for shorts, the new distal level as new HTF zones form. This allows you to ride the wave of the trend while capturing significant profit potential. Risk allocation. To manage two targets effectively, split your position into two trades. Allocate 50% of your risk size to the first target and the remaining 50% to the trailing target. This strategy ensures you capture immediate profits while keeping a portion of the trade open for larger potential gains, a method we call riding the wave. These simplified rules are designed for those new to trading. Over time, as you gain experience and refine your approach, you may adjust these rules. For instance, you might discover that trend trades can offer greater profit potential beyond a 1:4 risk to reward ratio. Additionally, if you're following trades from our live trading sessions, feel free to use the targets we provide instead of the beginner guide. In the next lesson, we'll take a closer look at these trade types, exploring their probabilities of success and profitability. I'll also introduce a decision matrix to help you navigate your actions based on the trend's location and current market conditions. But for now, let's jump into the charts and see how to apply these trade management rules in real time. Let's move into the practical application. Welcome traders to my practical application. Today I will talk about direction. We'll talk about an uptrend, downtrend, sideways, and anticipatory trend. Here we will use our Campus Fund trading platform. That's TradingView. We can execute and analyze all of our trades here. Okay, let's start with this example. That's a Bitcoin on the daily time frame. And the first step on direction is from right to left to identify 3 highs and 3 lows. You'll do this together. We add the arrows. Okay, great. First, the lows. Okay, this is our first low. Another low is here. And finally, there is another low. That's here. We have 3 lows, and now we need also 3 highs. First high is here. Another high is here. And finally, another high. Great. We have 6 pivots in total. Let me connect the pivots now. It's a high, low, lower high, lower low, another lower high, and a new lower low. This here is a downtrend. We have lower lows and lower highs. Perfect. Let's talk about the correction and impulse moves. The impulse is always from the high or lower high to the low or lower lows. Okay, all the way from the highs or lower highs to the lower lows or lows are our impulse moves. Best profit margin. And the correction moves always from the lows or lower lows to the highs or lower highs. That's a correction move. Less profit margin. Okay. We should expect now a lower high, right? It is a downtrend, and then, okay, the next is a lower high, and then a lower low. Remember, on location, we would like to sell here, right, in the very high or high area, and we should expect now a lower high here, and then a lower low. Let me press the play button. And you can see we filled more orders. And here, look at this. We created a new lower high. Look, it's lower than the previous lower high. And then a new lower low. The trend is our friend. Great. Okay, we are done with the downtrend. Let me press the play button again. So, look at this. Something changed here. On the left side, we have a downtrend, right? Lower high and then a lower low. What happened here? Let me add again some arrows. This one is a high. This one is a higher low, right? Another higher high. Okay, this sounds, it looks like an uptrend. Here, we are missing the higher low, right? The next higher low. We could talk about the anticipatory uptrend here. What we need is a new higher low, and then, of course, a higher high. Let's anticipate the higher low. And of course, here we need demand, right? I don't know, maybe here, like this. Then to create a new higher low and then a higher high. Let me press the play button. Let's filled more orders and then we got also a new higher high. Perfect. Copy paste. This one is our higher low. And here, another higher high. And a higher low. And this is an anticipatory uptrend. Okay, we remove this here. And now this is an uptrend. Here, the impulse is always from the low or higher low to the high or higher highs. Okay, this is the impulse, best profit margin. The correction is always from the highs or higher highs to the higher lows. This is our correction moves, less profit margin. Okay, great. We talked about the downtrend, the anticipatory uptrend, the uptrend. Last but not least, we have to talk about the sideways trend. And here we will follow the same steps from right to left and we'll identify the pivots. We prepare pivots. Okay. This one is a high. This one is a low. This one is another low. We need 6 pivots in total. Now we have 4. Now we have 6. You can see we have 3 lows and 3 highs. Let me connect the pivots. That's a low, that's a high, that's a higher low, higher high, and then we violated the higher low, the previous higher low, all the way down, low, and then this one is a new high, right? That is sideways. There's not a clear direction. They are not higher highs or higher lows or lower lows, right? That's not a clear direction to the upside or downside. It is more like sideways. And we have also no correction or impulse movements here. Great. That was my practical application about direction. See you in the next one. You have reached the end of lesson 4. Congratulations on completing another step in your trading journey. Before I sign off, let me remind you about our weekly practical application live class, which includes a dedicated session on direction. These live classes are an incredible opportunity to put what you have learned into practice, refine your skills, and get your questions answered in real time. If you can't join live, Don't worry, every session is recorded and available in the calendar, so you can revisit it whenever it fits your schedule. Be sure to check the calendar on the OTC website for more details on exact timings. Thanks for sticking with me through this lesson. I look forward to seeing you in the next one.